Hello and welcome. Today we're going to be looking at how to build a basic LBO model. So we're going to start with some sort of deal modeling stuff, thinking about shares outstanding and the treasury stock method for in-the-money options. We're going to have a management equity rollover. We're going to build out our sources and uses. We are going to work out the debt, the leverage ratio, the fees. All the kind of opening balance sheet adjustments, especially the purchase price allocation, to figure out what's the new goodwill, what's the new equity. That's kind of the most complicated part of that. And then some basic financial projections. And then later on, we're going to be adding on the option of a dividend recap. We're going to be adding on the option of a bolt-on acquisition. And for all of these and varying the exit timeline, we're going to be figuring out what the impact is on the sponsors' returns, their IRR. So let's dive on in and get started. We've got an Excel. I should kind of say, if you're new to my channel, this is based on a case from the Financial Modeling World Cup. This one is case 3 from round 6 from 2024. It's called XLBO by Sameer Jagetia. So with all these cases, we get a few pages of instructions like this with the details. We get an Excel file with the various financial assumptions, and then we also get a question file like this with I've got the version with the answers highlighted because I've done this case before. All right, so enough yak. Let's start with the deal modeling stuff. I guess I'll just put this on a new tab. So just call it deal. I'm gonna get rid of that, and let's see, where are we starting? Let's start by doing the shares outstanding. So we'll just bring over all of this. Boom. Put it there, get rid of that, open that out, and format. So then this is, sorry, they're already labeled here, so that's fine. Actually, I'd prefer to have it up here. So this is going to be number of shares. Then this is going to be number of shares slash options. Then I want the net shares. So for the basic shares, they just carry over. But then for the options, the idea is that if we have options at an $8 strike price, then these 1.4 million options get exercised. We get $8 million from that, but we use it to buy back shares. And sorry, I seem to have missed the bit where it tells us there we are. We're looking at a $15 share offer. So in other words, if we exercise here and have 1.4 million new shares, but then we use 8 million to buy back, let's say roughly half that number of treasury shares at $15 a share, then we'll end up net with about half that. So what does that mean? It means we'll end up with this many new shares, and then our new money will be that times the $8, and that will translate to that divided by 15 new shares, which means that our net new shares will be one of those minus the other. And so we don't have to spread it out all like that. We just say times 1 minus, and I suppose we should really have the exercise price in a cell, because this is not good. So say strike price, and that is 8, 10, 12, 14, 16. So then here we can say this times 1 minus this over, or 15 is over here somewhere, there. And copy that down. But watch out, here it's saying we go negative, which doesn't make sense. This is exercising shares whose strike price is above the share price, which we should never do. So we're instead just going to say, actually, let me just bring over the offer price, have it in a cell here, because that'll make this all make much more sense. So then we're going to have, just point this to there instead. Sorry, F4 to lock. And now we're going to say if this is less than this lock, then we're going to do this where we exercise the options and then buy back. Otherwise, 0, because we're not going to exercise the options at all. So then final shares outstanding. it's just the sum of all of those. I think we can already answer our first question or two here. Oh, sorry, we have a different question about the normalized share price first, but here we are. Diluted shares outstanding should be 94,052,827. And it is. Hooray. All right. So now let's go look at the normalized share price piece. So a public company, you're making a tender offer of $15 a share. Rumors of potential transactions started before the tender offer was announced. On the day the rumors emerged, the stock price jumped over 20%. To evaluate the offer price, calculate the normalized price as the average share price for the 30 days prior to the rumors start. So we've got a share price table here. And you can see it's kind of trucking along, 10, 10, 10, 10, 10, 11, 11, 11, and then it jumps. Now, there's lots of ways you could do this with formulas, but honestly, by far the easiest way to quickly spot the date where this jumps is just to hit F11 and turn it into a chart, mouse over this, and there it is, 22nd of December. It jumps from 11:33 to 13.7, and then we can just delete the chart because this is the kind of analysis you only need to do once. So then our normalized share price is going to be the average of the 30 trading days before that big jump on the 22nd of December. Just zoom up here. Again, you could be more formulaic about this. You could use a formula to identify the date where it happens and all that, but you don't have to. So that's the offer price, and then based on that, we can calculate the premium, which is this over this minus 1. So our normalized share price is $11.06, and our premium is 35.6%, and that's all good. Okay, so now the equity purchase price is just going to be the number of shares times the shares outstanding, sorry, the price per share, offer price per share times the shares outstanding. And let's do this in millions from here on because the numbers are getting large. And again, we've got a question on that, and sure enough, it's 1,410.8 million. Happy days. Now, right, then we also want to work out the enterprise value. So we'll work out the net debt at acquisition, also in dollar million, and that is, we have our balance sheet here. So we're going to take our debt minus our cash. And then we'll have our enterprise value, which is just going to be the sum of those. And then I think the question asks about, yes, our acquisition multiple, EV over last 12 months EBITDA. So EV over LTM EBITDA is going to be that divided by EBITDA is here. So this is our forecast P&L, but it includes our 2024 actual. So it's right there. And that is 7.84. Or if you're feeling fancy, you could add an X to the number format. Okay, so we're good up as far as there. Now we got to get into the sources and uses. So let's do it. I'm just going to narrow that up. And actually, let's insert another column here. So just start with, call it deal modeling. Then we'll come down here and do sources and uses. And this case is quite prescriptive about sources and uses that it wants you to use. So your uses are going to be the equity purchase, the refinancing of the existing debt, setting up the minimum cash level, transaction fees, and financing fees. So let's just do it. Oops, come over here. So we'll say uses. So it's the equity purchase, net debt refi, min cash level. This seems like a slightly odd way to present it to me, because when you're refinancing the net debt, it means you're using all the cash to pay off the debt and then adding more cash to pay for the minimum cash level. So like you start off with a company that has 150 million in cash and you end up with a company that has 35 million in cash, but somehow you think of that as I'm adding in 35 million. Not intuitive to me, but anyway, the numbers add up to the same amount either way, so it doesn't really matter. Transaction fees and financing fees. And then we have our total uses. So the equity purchase, and I guess we'll just label this at the top, $1,000,000, keep it simple. So the equity purchase is that guy. The net debt refi is this guy. The minimum cash level that we need in the company going forward is the 35 million, which is over here somewhere. There it is. Then our transaction fees, we have an assumption here. I think it's also spelled out in the PDF. Here we are. So there's 2.5% equity advisory fee on the full equity value of the deal, and then there's a financing fee of 2% of the debt. And the debt is, we can get up to 6x LTM EBITDA. So I guess I might as well put that in the deal modeling section. Seems as good a place as any. So new debt amount. And that is going to be our leverage times last 12 months EBITDA, which is again that 250 million, which means we'll be able to raise 1.5 billion in debt. Okay, so then our transaction fees are, I'm just going to link here to there's the equity transaction fee, and here's the financing transaction fee. Make those both percentages, add a decimal place, and just make them gray, because it's just easier to see what's going on then. So then it's going to be that times that for our transaction fee, and our financing fee is going to be this guy times that. And then our total uses is going to be the sum of all of those. And then our corresponding sources, also in $1,000,000, are going to be the sponsor equity, the new debt issued, I guess I should put that down there, and the management equity rollover. Rollover? No, rollover. Thank you. And let's just quickly, where's the bit about the management rollovers? Back up here. So the rollover, equity rollover refers to the portion of a company's ownership that the existing management team reinvests or rolls over. So in this case, they have 7% ownership in the company after option exercises, and they're going to roll that over into the new company. So their 7% is, and again, let's come and link up here because it makes it easier to read. Where is the 7%? Here it is, rollover equity. Is just this times this. So they're rolling over just about $100 million in equity. The new debt, already figured out, is this guy. And total sources. And now the whole point, obviously, of sources and uses is your totals have to match. And in this case, we want the sponsor equity to be the balancing number. So we're just going to say, let that equal that. And then the sponsor equity is going to be the total sources minus the sum of the other two, which is 462.3. What do these ones have one more decimal place? Don't know, but get rid of it. Okay. So now let's answer the questions on that bit. Total value of transaction fees and financing fees should be 65.3 million. And yep, that's what we've got. Okay. Total amount of equity contributed by the sponsor, including fees and new cash. Yeah. So 462.3. Good. Oh, and then yeah, we haven't come to the PP&E write-up, and generally to the opening balance sheet. So now that is our next kind of topic to touch on here, which is the opening balance sheet. So we'll do balance sheet adjustments. So we'll just take our balance sheet here. guess we'll carry over this format. Take our liabilities and equity. So we sum those two, and then we sum these for our total liabilities and equity. And let's carry down our formatting. And then let's add a check, which is this minus this. And let's format that as general. Okay, actually, no, let's format it as 0. Okay, good. So then this is going to be as of December 31st. And then we want adjustments, then opening. And so these are all just going to be add on the adjustment and get that. And similar here, and here. And put that there as well, and here as well. Okay, so what are the adjustments? So the first thing just to mention is PP&E will be written up by 10% as part of the transaction. And then there's extra stuff later about how we amortize that, but for now, I guess let's go grab the 10%, same as I've been doing with other things. PP&E right up, there we go. So this will just be this times that. Sorry, I'll carry over our check. So now obviously we're out of balance, but that's okay because we have a bunch of other stuff to do. So the cash adjustment is going to be minus this plus our new cash. So we're going down to 35 million. So that's good. No change to accounts receivable, no change to inventory. Lots of changes to goodwill. We'll come to that in a minute. Changes to debt, of course. So it's going to be minus that plus our new debt sort of here. No changes to accounts payable, lots of changes to equity. Again, come to that in a second. But before we get to that, I think I skirted over it when we were in the debt. Where are we going? Interest expense, no, it's in the fees section, here we are. The financing fees are capitalized and amortized over the life of the debt. So we're going to need an additional asset, which is, call it financing fee asset, which is initially 0, and then becomes 30, and ends up as 30. Okay, so now all the rest of the complication is what happens to goodwill and what happens to equity. So let's get into it. Equity, let's start with goodwill calculation. So we've got our equity purchase price, and that is our 1.4, wherever that is here. Then we've got the book value of equity from before, which is this 730, but that 730 includes 360 of goodwill, so it's really only 370. So goodwill, I guess I should just, to be extra clear, I'll call it old goodwill. Clear but not professional, but that's fine. So then call it net existing equity. It's going to be that minus that. So then, and again, there's a specific language that they call for here. So yeah, that is the purchase premium. So the purchase equity value less the equity net of goodwill. So that is the purchase premium is this minus this, but then the bit of that that goes to, so basically the value of what you're buying according to the accounts is the equity minus the goodwill, but you're also then increasing the PP&E value. So we're going to add that back. So PP&E right up is that. So then our new goodwill will be this minus that. And so our adjustment to goodwill will be this minus the old goodwill. And so that is the number that goes in here. Okay. Now, if you're feeling cheeky, we could just make equity the balancing number here, but let's be a little more proper about it. So we'll do equity calculation. And that is, it's actually pretty straightforward. The only thing is in the fees. Here we are. Transaction fees are immediately written off as expenses at transaction close. So that's just the one thing you need to watch out for. So we're going to have our rollover equity, our sponsor equity, and our transaction fees, and then that will all bring us to our new equity. So the rollover equity is the 100 million or so. The sponsor equity was 460, and then the transaction fees is going to be negative 35. So sum that up. That's our new equity, and then similarly we'll want equity adjustment. That's going to be the new equity minus the old equity, which brings us to minus 204, which coincidentally is exactly what we're off balance by. Hooray! So we put that in, and everything balances. And honestly, that would literally never happen to me in the case without having to like spend a bunch of time scrutinizing, every movement up here and where does that get reflected down here. This stuff is not intuitive to me. But there you go. I did it efficiently for you. All right. So next is to get on to the financial projections. But I think I've done as much as I have time for right now. So I'm going to pause there and come back to it later. Okay, I'm back and it's time to get on to the financial projections. So I'll just kind of quickly run through the relevant assumptions here. So we need to build a 10-year annual model, 3-statement model. And this we've already dealt with. Transaction fees we've dealt with. This is kind of in an odd order. Let's start here. So we have actual financial results for 24 and financial projections for the next 10 years, including the P&L and capex. We want to build a 3-statement model. Some of these stay exactly the same, so sales, COGS, SG&A, etc. are not affected, while others need to be adjusted based on the changes in the company's profile after the transaction. E.g., we have a new set of debts, a new interest expense. We had a write-up on the PP&E, so there's new depreciation to deal with, and tax. Then the debt, we have the details here. So it's a 15-year payoff schedule. Debt paydown occurs at year end, so the interest calculation is based on this opening balance for the year, so no kind of average balance shenanigans, circular references, all that jazz. But also there's a cash sweep, so if we have more than the $35 million minimum cash, then we'll use that for additional debt paydown. And then if you remember, we capitalized the debt fee into an asset on the balance sheet. So that's going to be amortized over the life of the debt. But if the debt is fully paid off ahead of time, the remaining financing fees are written off on the day of the final repayment. Anything else? So the working capital, we just maintain the same ratios of accounts receivable days and so on. With this killed me on the day after years of the trap being, hey, you forgot to adjust for it being a leap year and there's one extra day. Now this time around I adjusted for the leap year because it's muscle memory now, and surprise, you don't take account of leap years this time. And then we're going to exit after 10 years on an 8x last 12 months EBITDA multiple, and then part 2 we'll come back to later. All right, so rather than make you watch me do everything, because a lot of this is pretty kind of rote, I'm just starting off from a template here. So here's a space for an income statement, and I've just made the kind of connections here. So, you know, whatever, if I have $100,000 of revenue, then that flows down into my gross profit. And if I have $555 of COGS, that's just getting subtracted through. The balance sheet and the cash flow. And the cash flow is just now, it's net income, adjustments to come, and then add those adjustments to get net cash flow, and then add that to opening and get closing, and go on from there. So I'm going to start by building the balance sheet, because I find keeping the balance sheet in check is a good thing to do as we're going along. So we've already worked out in the deal model the opening balance sheet. So we're just going to take all of those. We're going to take the debt and accounts payable, and we're going to take the equity. Nice, easy start. And then I'm going to start by just filling all of these in, and because if you start from a balancing balance sheet and then layer in all your changes as you go, it makes it a lot easier to figure out, you know, if something has stopped balancing, and if so, at what point, and so on. Okay, so there we go. And now we can start with the income statement. And again, most of this is given and doesn't change much. So, you know, we have an assumption for revenue. Sorry, just from 25 on. Oh, and actually, sorry, I forgot to finish my setup here. And actually, I know the first one is balancing. So, and I'm just going to do some square of these. And basically, whenever we're in balance, this should be 0. So I'm going to add, I like to make it obvious and alarming, so I'm going to add format cells where this value is true. This is greater than, let's just say, 10 to the power of minus 5. And format can be alarming red fill. So right now, we're out of balance, alarming red fill. And the easy fix for that is, so what's happening is we have revenue that is flowing through into additional cash, but we don't have the net income flowing through into equity. So if I just add the net income here, that should resolve itself, and it does. Now, obviously, we have no costs flowing through, so this is a very optimistic scenario, but it is an optimistic and balanced scenario. Why on earth is this one still red? Huh? Okay, that was just a update delay or something. Okay, so where do we want to start? I guess let's start with some of the easier ones. The accounts receivable, inventory, and accounts payable, the working capital stuff, is pretty simple. So let's go for that. So we've got a number of days for each one. I'm just going to bring these in here. I've actually got a handy little robot command I'll show you that I like for cases like this. So let me just get them in the right order. This is accounts receivable. It's called paste assumption link. And what it does is it pastes a link to the assumption that you copied, puts that grayed out, as in, you know, this is just a kind of copy, it's a helper, it's a reference, whatever, and it also marks in yellow the assumption that you've used here. Obviously, I haven't used it for the whole thing, but if you use it for the whole model, it makes it much easier to keep tabs of, okay, wait, I've used all these assumptions except this one, I still need to do something with that, and so on. But anyway, for now, we don't need that. So I'm just going to bring each of these in. And accounts payable. And just check, are these done on anything funny? No, just revenue and COGS. Okay. And since it's just 365, so our accounts receivable is going to be revenue times this over 365. And that immediately gets us out of balance, which means we have this changing the balance sheet, but the change in working capital is not flowing through to cash. So we'll make our first adjustment here. We've got a change in working capital. And I always have to pause and think about the sign for this. So it's going to be this minus this, plus this minus this, plus then for the one on the liability side, it's the other way around. It's the new minus the old. And that gets us back in balance. Hooray. And now we should be able to pretty easily do the same. Actually, sorry, won't really make much sense if I don't have the cogs in. So let's go get the cogs from here. And now we can do our inventory as cogs times lock that over 365. And you see this time we stay in balance because we've already done the working capital setup. And then here, accounts payable again is going to be all of cogs times this lock over 365. Okay, so that's nice and simple. Then the SG&A is also not changing, so let's just grab it here. EBITDA is good. The D&A is going to change, but we can start off with, because the D&A includes depreciation of the existing stuff and of the new capex, so we're going to need that, but then we're going to also need to add in additional depreciation for the newly written up PP&E and additional amortization for Goodwill and for the financing fee. But that's a start. Then interest, we're going to have to build a debt schedule, and tax, I think we just have a fixed tax rate. Yes, 25% tax. So we can just do that. Equals this times this. Obviously, you know, some people prefer to have a minus sign here and just have this be a sum. Either works as long as you're consistent. Okay, so then we need to amortize these things. We need to build an asset schedule, and we need to build a debt schedule. So let's start with the Goodwill, because that's just a simple standalone thing. It's interesting. I was thinking that this should have got us out of balance, but of course I haven't hooked it up to PP&E yet, so yeah, that's fine. But we will need to add back depreciation and amortization in the cash flow later. But anyway, not now. Okay, so Goodwill amortization. Now I do remember feeling anxious about this because this did not mention whether it included amortization of the existing Goodwill, and if so, on what timeline, and blah, blah, blah. I think we were meant to just amortize all of the new. Let's just see if it actually spells it out somewhere. The post-acquisition Goodwill will be amortized over 15 years. So I mean, that only works if this didn't actually include any amortization in the first place, which made me a little uncomfortable, but I think that is the idea. So yeah, it's just going to be simple. Opening, amortization, closing. So back to our deal model. There's our Goodwill. And then somewhere in here we've got an assumption that is the 15 years here. No, that's the debt repayment. Goodwill, there it is. So paste that in. And then we'll just do minus this over this. If we were being more proper, we would say, you know, minus the minimum of that and the opening balance, but it's 15-year amortization and the model only goes out 10 years, so it doesn't really matter. So now our Goodwill will point to here. And we're out of balance. Oh no. And then we come up here. And actually, let's just make these individual cells rather than all grouped. And then we're going to add in, or actually subtract, because we've got a positive sign up here and a negative sign down there. Subtract out our Goodwill amortization. Right, we're still out of balance because we're not adding back. Okay, so now we're going to have to do a couple of things at a time. So add back D&A. Actually, you know, no, I'll keep it simple. For now, I will just add back this piece, and then we'll add back the bit that's to do with PP&E later, because that'll let me do the two separately and get back in balance right now. Okay, so that's the easy piece. Then we need to do the debt schedule, which will cover the financing asset, and we need to do the PP&E. Let's do the PP&E first, because that's actually pretty simple as well. So for the PP&E, we already have a depreciation number that reflects, where are my words? A depreciation number that reflects the the existing assets and the new capex over the time. So the only new depreciation we need to add is the depreciation of the write-up. So where is that going? Write-up. No, that can't be the, anyway, whatever. Yeah, this can be viewed as an incremental depreciation to the target's projection since the original PP&E depreciation is already included, and that's depreciated over 10 years. Okay, so new PP&E depreciation. So we just got opening, depreciation, closing. So again, the opening is the 75. There's that. Okay, so then our overall PP&E balance, we got our opening, our capex, our depreciation, and then our closing balance. So this is going to start off as wherever we are, PP&E, the 825. And then the capex is going to be from over here, right down the bottom, 2025. Then the depreciation is going to be, now this is where you need to know, is this in fact D&A? I think the answer is that it's really only depreciation. So we're going to say minus that, but we're also going to say we need to subtract off that. Now there's a few different moving pieces in here, so I'm moderately nervous about getting everything to balance first time, but let's give it a shot. So our PP&E closing balance is going to come from down here. Alarmingly out of balance, don't worry, we got time. So now we're adding back depreciation and amortization. Actually, sorry, let's come up to our D&A line here and make sure we add in our new depreciation from down here. Then we need to add back the full D&A line, not just that bit, which is here. And then what have I still not done? I have not done capex. I've got it here, so I'll just point to that, I guess. Bother, we're still out of balance. What have I failed to do? Okay, so out of balance by small but growing amount. Haven't done anything with interest yet. Depreciation and amortization doesn't have the amortization of the thingy thing yet, but it shouldn't. So I guess does the amount that we're out by, it doesn't match this. It's not miles off that, but it doesn't match it. I delete that, and that doesn't change anything. Okay. All right. So maybe there's too many things going on at once. Let's simplify. So let's start by getting rid of the extra depreciation for a minute. Now, one good check would be, am I pointing at the right column? Column E is 2025, yes. So Goodwill amortization and wait, this is pointing at column D. Ugh. This stuff can kill you. It needs to be pointing at column E. Okay, now we're back in balance. Now I can put back the minus this over this. Wish I could say I'd given you a master class in how to deal with an unbalanced balance sheet, but again, the important thing is if you build the plumbing first and then add in one piece at a time, you at least can narrow down very narrowly exactly what you're looking for. So now let's just see, we've got E, E, E. Okay, everything's pointing where it should be. Let's go on and build a debt schedule. Debt schedule. So again, we're going to have opening. Have an option for a draw because the dividend recap and the bolt-on acquisition will both add to debt. Then we'll have our scheduled repayment. Then we'll have our cash sweep. Then we'll have our closing. And then we'll calculate our interest and our fee amortization. Actually, it's just opening, amortization, closing. Okay. So our debt starts off at the 1.5, where's it going here? 1.5. No draw for now, scheduled repayment based on 15-year amortization, which is here. Now here we do need to be careful with not paying off more than we should, because with the cash sweep it could get paid off early. So we're going to say minimum of that and this over this. So now if I make an early repayment of 800, then we don't keep making scheduled payments after the debt is paid off, which is important. Okay. Then the interest is going to be 8.5%. And it's just straight up on the opening balance, no days, no funny business. Do have to lock the cell though. All right, so then let's link the interest into here. And everything stays in balance and we're happy. Then we'll do the fee amortization. Yeah, we'll just start with what's in the deal modeling sheet. Then we'll say, so the key thing with the amortization is that amortization, wherever it's gone. No, not there, it's in the fee section. Yeah, if the debt is fully paid off ahead of time, the remaining financing fees are written off. So we're going to say if the closing balance equals 0, then clear it all. Otherwise, minus this over this. So again, let's just say we pay off 850 here, then the rest of the fee blows up there. Cool. All right, so now let's start plugging some things in, and then we'll figure out the cash sweep, which is the more complex part. So first things first, we'll do the balance. And to offset that, we'll need to put the principal payment into the cash flow schedule. Sorry, I don't need a minus to it because it's got a negative sign already. And we're back in balance, hooray. And sorry, I'll call that scheduled payment. Okay, so then I'm going to modify this a little bit. I'm going to make this net cash flow pre-sweep. Then, oops, daisy. I'm going to do closing cash pre-sweep. And that's going to be this plus this. And whoo, we're getting awfully tight on money. Then we're going to do the sweep, which is going to be just if this is greater. Actually, let's grab our minimum cash balance assumption. Wherever that is, it's here. So we're going to say if the closing balance pre-sweep is greater than this, then I want this minus this, otherwise 0, which I guess could be more efficiently written as just max of that and 0. Cool. And then our closing cash is going to be this plus this. Oh, sorry. Pause. Has to be the max of that, but also the min of that, and the balance available to be repaid. So this plus this. And I guess plus the draw technically, but fine. Okay, and then boom, we're out of balance. Cool. Where else does that need to hit? I've already linked the closing cash. Where are we out of balance? So 25 is coming out of, oh, sorry, I didn't copy this formula across. Stupid. It says we're still out of balance. That's, oh, because I'm adding and not subtracting, because I'm silly. Okay, so now we're back in balance. So now, oh, and sorry, this has to be pointed to here, which gets us out of balance again, and then we need to add the amortization of the financing fee into our D&A line, which is here. Oh, circular reference, that's not good. I thought I had managed to, oh, right. Yep, because the net income depends on the interest, which depends on this bother. Well, the very quick fix is there's not actually a circularity here, I think. So if I just say that's okay, then that works. The more robust fix would be to rebuild the cash flow statement to start from EBITDA, I guess, and then make interest and tax adjustments. Do I want to do that? Yeah, I'd feel bad if I left this like that. So let's do that. So we'll do EBITDA. So then we need to make adjustments for, we got to get rid of adding back D&A, and we need to adjust for interest and taxes. So, get rid of that, add in interest, taxes. And then point this to there. And we're back in balance. Phew, wasn't sure that would work first time. Now we should be circularity free. We're not. Bother. Why not? I thought I had been careful about this. Right, because of the amortization. Bother. Okay, well, here's what we can do. We can link this further upstream, I think. So we can say if the opening plus the draw plus the scheduled repayment plus the cash sweep, sorry, minus the cash sweep is equal to 0. That, no, that does not resolve it. Bother. What have I done here? I think I'm going to pause the video and work this out rather than making you watch me puzzle through it all, because it's going to take a little bit of digging, but I'll be back. Okay, I scratched my head on this some more. I was sure I must be doing something silly to have created a circularity. Looked at the solution model, which also contains a circularity, thought about it some more, and I realized, okay, actually, I think this is fundamentally a circular situation in a way that is not actually avoidable. The good news is that the circularity is over a kind of threshold question of like, is this paid off or not, which means that you won't have, you know, a circularity that will potentially loop, and you have to think about whether it converges or not. But and this doesn't apply here. I think it would only apply in an edge case. But I do think it means that the logic of this model could have two steady states. In other words, I think there could be a situation where you follow through the calculations, you don't have enough cash to pay off the debt, and so you get, you know, just the small amount of amortization, but you're very close. And that if you like temporarily forced it to make a larger payoff, you'd pay off the debt, therefore you'd get the bigger amortization, therefore you'd get the bigger tax shield, therefore you'd get a lower tax bill, and therefore you'd actually have higher cash flow, which might then give you enough cash flow to have paid off the debt. So I think there's like a weirdness here where you could have two different steady states. This is the kind of thing that I talk about when I say circular references and models are bad, and people think I'm just being weird and theoretical, but could happen. Anyway, I have gone back to the model being circular, and we'll just pretend everything is okay. All right. So now we should be ready to go answer some questions and see if we're on the right track. So we've done up to question 9. So question 10, what is the total debt principal pay down in 2028? We should have 126.9. So I think that's the first year that we sweep. So 2028 is here. And sure enough, we have 126.9. That's good. The leverage ratio in 2028, ending debt over LTM EBITDA. So let's just add that in here. Leverage ratio, ending debt over LTM EBITDA, which is here, 17, yes. And we want what? The 2028, 2.89, yes. Okay, sorry, I thought I'd read 2.88. I was like, no, how can I be off by 0.01? Okay, book value of PP&E in 2030, 2030, be a million? No, I do not have a million. Bother. What have I done wrong? Oh, sorry, PP&E. I'm looking at equity. That's the next question. PP&E 829, 828.7. Good. Retained earnings balance, equity and retained earnings 2031, 1148.3. Yes. Pro forma net income in 2032, 171.2. Hopefully 2030. Wait, 1, 2, 2032. Okay, 171.2. Yes. Exit enterprise value. Oh yeah. So let's do our exit modeling now. So exit. Exist? No, we're not being philosophical here. So exit year. And I'm actually gonna. We got assumption for an exit year. Bolt-on date, dividend recap date. Okay. Well, I'm just gonna put an assumption over here then. Grab something that's formatted as a number. Never mind. I'll just. Boom. Exit year is 10. I guess here let's just put year num. And that could just be year of this minus year of that. Okay. Then exit valuation can just be this equals this times the EBITDA, which is way up here, times the multiple, which I will link over over here, and that is 8x. That's for the bolt-on, but I think it was the same here. Exit multiple. Thank you. Okay, so we got 3761.3. Yes. Sponsor IRR. So sponsor cash flows. It's going to be negative of the amount they pay in at the start, and then we need to clear out. Ooh, do we have to leave 35 million in the company or not? Let's assume not. Okay. Sorry. So then equity return should be, again, let's just do this equals this times, so it's going to be this minus the closing debt plus the closing cash. We're flush with cash at the end, but okay. And then we need to split this, so to management, to sponsor. Oops, sorry, we'll need 6. Why I put these in a different column than all the rest. So the management is going to be this over some of these. And the sponsor is going to be 1 minus that. So as you would expect, because the company becomes much more leveraged with a much bigger debt, and management maintains their equity value, their share goes up quite a bit. So they went from 7% to 18%. So then we'll do this times this. Then our sponsor cash flow is going to be this, and then sponsor IRR. XIRR, these are the values, these are the dates. Is it 21.7%? No, bother. What have I done wrong? Remember that EV/EBITDA gets you the enterprise value. Don't forget the bridge to equity value. Also remember the rollover 7%. Whoa, 7% of the sale proceeds? Okay, I don't think that's right, but let's go with that for a second. That gets me to 23.2. Huh. I don't think that's the right way to think about management's share. Their share should increase because they are investing 18% of the equity. Okay, I'm raising an eyebrow at that, but fine. For now, we'll point this over to here. Actually, let's do it properly. Do it like this. Fine. But not fine. I don't think that's right. Anyway, okay. What is the sponsor IRR with a 5-year holding period and exit in 2029? So we'll just make this 5, and it should be 34.79, and it is. Okay, so now we got to look at the last bit, part 2. So there's a dividend recap and a bolt-on acquisition. So the sponsor plans a dividend recap at the end of 2028, targeting a debt to LTM EBITDA of 6x. The proceeds from the incremental debt will allow the sponsor to pay a special dividend. 93% to the sponsor, 7% to the management. Again, not good. This gives them an opportunity to recoup some of their investment without changing the ownership stake, and will boost their IRR since they will realize a portion of the investment return prior to a full exit. Sure. The interest rate in the new debt will match the original acquisition debt rate. The new debt will not affect the mandatory annual repayment, but any excess cash above the minimum cash balance will continue to be used for paydowns. Dividend equals the incremental debt raised to reach the target leverage. Incremental debt is calculated after mandatory amortization and additional paydown for the year until the minimum cash balance is reached. Okay. So, those are what's the timing? 2028. Do we have? Yes, we have an assumption for that. So I'm just going to build out a little more space here. So dividend recap and bolt on. So we need both of these. So I'm just going to say if the date, ending date, is equal to this, then it's going to be 6 times the trailing 12 months EBITDA, which is up here, minus the closing debt balance. But not minus the closing debt balance. We're going to say minus. Ooh, hang on. Oh yeah. So I was thinking, am I going to introduce a circularity here when I tie in the draw to the cash flow? But actually no, because whatever gets drawn here gets paid out immediately. All right. Anyway, sorry. What am I doing? Minus this minus this minus this. Otherwise 0. So we should be able to draw another 1.156 million. Now, is this going to create a circularity when I link it in? Well, I guess not, because the way I've set it up, there are no circularities, but it is going to throw us out of balance, which is fine. Then we need our equity to go down by that amount because our debt has increased, but our cash has not increased. So do that. Cool. Back in balance. Now I should have a switch here as well. So let's do that. One. Just make it all times this. Okay, and then I can turn it off. Good. All right, so then the equity return, I just need to add plus this, and that'll get divided up in the same way. Okay, so then what's the question? If they execute a dividend recap, how much incremental debt is raised? 1,156, I think that's what we had. Yes. And dividend recap in 28 and an exit in 34, which is year 10. 33.28, yes, good. What is the sponsor IRR, assuming a dividend recap in 28 and an exit in 29? 39.11, yes. Sponsor, okay, so now bolt-on acquisition. Tell us about that. Instead of the dividend recap, the sponsor is planning a strategic acquisition of a smaller competitor that will expand their market reach and has complementary technologies. This bolt-on acquisition will close on December 31st, 2028, with a purchase price of 8x LTM EBITDA. The acquisition will be fully financed with debt on similar terms to the dividend recap. The amount of debt needed will be based on the acquisition price, not on the target leverage ratio. Fine. Incremental EBITDA from the acquisition is provided. Assume no additional D&A or capex from this transaction. Purchase price equals the fair market value of assets, so there's no goodwill created. Need to include a line item for the assets for the balance sheet balance. However, it will not affect the answer to the question in the case. Right. So where are my bolt-on details? Here we are. So this is their actual EBITDA that we use to value it, and then this is the forecast. So again, I'm just going to have a switch for this. Then where are we going to do this? So let's do additional EBITDA, which is going to be a function of the acquisition date, and then purchase price. And then let's see, have we? That's just years. Okay, so then we'll XLOOKUP, just to be vaguely formal about it, the year of that in here. returning from here. Then it's going to be this equals this times this times this. So we pay 515. The additional EBITDA then is going to be this greater than or equal to this times this from 25, not 24. No, sorry, it has to be greater than, because we don't get the 2028 revenues. So what else do we need to do? Finance it through debt. So plus this, which will throw us out of balance again, which is fine. I'm just going to clunk it into the, you don't even need to do it, but I'm going to clunk it in here. Acquisition. Oops, that's very fine. I won't put it there. Acquisition. And just make sure that this is there, and this equals that plus this. And that gets us back in balance. Obviously, that's not by any means a full treatment of it, but it will do for now. So what else do we need to do? We've got it flowing into the debt. So we're going to turn off our dividend recap just to our bolt-on acquisition, and then I think we're ready to answer the question. So dividend recap we've done, bolt-on acquisition in 28, exit in 31. Bolt-on acquisition in 28, yes. Exit in 31 is year 7, I think, yes. 23.84, no, oh dear. For that, oh, sorry, I didn't actually add it to our EBITDA. Whoops. That would help, wouldn't it? Plus this. Now we're 30.11, which is good. Okay, and then if we do both the bolt-on acquisition and the dividend recap and exit in 2031, and this is a little bit cheeky because, yeah, the dividend recap occurs first to get you up to 6x, and then you bolt on afterwards, which means that you will breach the leverage ratio. Fine. But we're saying that's okay. All right. So then we're going to turn both of these on and exit in 2031, and I get 38.25%. Hooray! Okay, well, I have to say this is this thing is still bugging me because I remember we had the Roca Rola rollover case. The whole kind of theme of that was how much the management increases their share. That seems like a mistake. But anyway, whew, I'm almost caught up now. I've just got one more section 3 to do, and then I'll have done all the FMWC videos for this year. They do, I have to be honest, they feel a little bit like a chore sometimes because it is it's a lot of work, and it's not even like just, you know, rush through it like in the competition. It's like you gotta actually tick and tie it if you're gonna make a video to say I'm gonna teach you how to do this. But anyway, all right, that's all I got for today. Thanks for watching. See you next time.